Welcome to Singapore, a tiny island nation located just off the southern tip of Malaysia. Despite its small size, Singapore boasts a population of 5.6 million people and an astonishing economic output of nearly $500 billion. This economic ability ranks Singapore as the 33rd largest economy globally, surpassing even larger nations such as the UAE, Vietnam, and its neighboring country, Malaysia. But Singapore's journey to success wasn't always smooth. Just 5 decades ago, it grappled with extreme poverty and the legacy of a long history of occupation. The remarkable progress this small island nation has achieved in such a short time has captured the attention of economists and commentators worldwide. Many are intrigued by the idea of other countries following in Singapore's footsteps to become their respective regions' success stories. The dream of becoming the Singapore of South America, the Singapore of Africa, or even the Singapore of Asia has been embraced by several nations, all inspired by Singapore's rapid transformation, although they might not have fully considered the implications of that last title. Considering that a once poor island with limited resources and global political influence could ascend to become one of the world's wealthiest economies, it might seem plausible that any nation could replicate this achievement. However, the reality is that emulating Singapore's success is an incredibly formidable task, as the unique blend of factors that contributed to its prosperity is essentially unparalleled elsewhere in the world. In essence, there won't be another Singapore emerging in any other region. A common misconception revolves around the idea that Singapore's prosperity is primarily built on glitzy industries flourishing in towering glass skyscrapers. It's understandable why people might think this, given the iconic images of Marina Bay, stories of global billionaires making the city their home, and its portrayal in contemporary media. But the truth is quite different, and even most economists often overlook the real drivers behind Singapore's success. So, what lessons can typical economies glean from Singapore's remarkable development, and can they apply those lessons within their own borders? What were the key ingredients that fueled Singapore's success, and why is it nearly impossible for other countries to replicate this achievement? Once we've covered these points, we'll be ready to include Singapore on the Economics Explained National Leaderboard. Singapore's journey as an independent nation began in a rather unique way. While many nations worldwide had to engage in fierce struggles or negotiations to gain independence, Singapore's independence was somewhat thrust upon it. The small island was once part of Malaysia and had a history as a key trade port under colonial empires. This history made the region incredibly diverse, but also led to significant tensions among the various ethnic groups that called it home. In the aftermath of World War II, following a challenging occupation by Japanese forces, Singapore faced the monumental task of rebuilding from the ground up. For the following decades, it essentially resembled a city-sized slum, with the majority of its residents living in abject poverty. Recognizing the potential for conflicts in such a diverse yet unforgiving environment, Singapore was expelled from Malaysia in 1965. The newfound nation had a unique advantage in the form of a distinct brand of benign authoritarianism. The new government recognized that, to address the country's issues effectively, it required a strong and decisive approach, which is precisely what they implemented. One of their initial actions was to reclaim extensive parcels of land from private ownership at below-market rates to construct affordable public housing. When people advocate for their own economies to emulate Singapore, they often overlook this crucial detail. Implementing a policy of this magnitude in any advanced economy worldwide today would likely result in political backlash. Singapore's approach to housing remains highly regulated, blending central planning with elements of the free market. Notably, income taxes in Singapore are renowned for their low rates. As of this year, the highest income tax rate is 24%, applicable only to individuals earning over 1 million Singaporean dollars annually, or approximately $750,000. This represents the free market side with minimal government intervention. Simultaneously, 20% of workers' salaries are mandatorily contributed to the government. However, this 20% isn't simply funneled into government expenditures. Instead, it goes into a substantial communal investment fund that residents can access for making deposits on subsidized housing. Additionally, workers benefit from an additional 16% contribution from their employers, also directed into the same fund, which serves as a source for retirement and healthcare funding. This implies that, at a minimum, people in Singapore are saving a substantial 36% of their income, which is twice the average savings rate in the United States. Singaporeans are known for their diligence in saving money, extending beyond these mandatory savings measures, with the average resident stashing away 54.6% of their earnings. Now, a high savings rate is meaningful only if the populace is earning a reasonable income. So the next challenge for the government was to attract industries that made sense for this compact island nation. One of Singapore's most significant industries today is far from the glitz of global finance. It essentially functions as a refueling station for the world's cargo ships. As Asia evolved into a hub for low-cost manufacturing and global trade intensified, Singapore established substantial oil facilities to import oil from the South Pacific and the Persian Gulf, supplying it to all the vessels passing through the natural choke point of the Malacca Straits. Due to its strategic location and the fact that crude oil freighters traverse the area regularly, Singapore boasts the world's largest bunkering port, offering prices even more competitive than those in the Gulf states. While Singapore does produce a modest amount of oil itself, approximately 20,000 barrels per day, this is just a minuscule fraction of the total oil volume moving through the country. To enhance its position as a one-stop solution for shipping needs, Singapore has developed the largest commodities exchange in the region, where companies and speculators can secure prices for resources traded across Asia. The government's unique blend of authority and free market capitalism played a pivotal role in establishing this industry. The oil sector necessitated significant capital investment to remain globally competitive, but Singapore, still a relatively impoverished country in the mid-1970s, couldn't make that investment on its own. To attract multinational oil companies and kickstart the industry, Singapore offered them the opportunity to share in the future profits. When international companies consider investing in a foreign country, especially a relatively new and potentially unstable one like Singapore at the time, they need compelling reasons to be there. Given Singapore's limited oil reserves, this alone wouldn't suffice. While the potential of its strategic location was recognized, economists argue that what truly made it an attractive choice was the significant freedoms granted to foreign oil companies to operate within the country, along with the security provided by an effectively one-party state that could guarantee policy consistency. Singapore also enjoyed the advantage of adopting an English common law legal system from its previous colonial rulers, a well-regarded and widely understood framework for settling commercial disputes. This legal system was much more appealing to international companies than alternative systems prevalent in the region. Being in the right place at the right time and having the right authority to negotiate favorable deals formed the bedrock of Singapore's economic success. While it's unfair to attribute all of it to luck, Singapore certainly capitalized on its initial success by reinvesting in its people and industries. However, had it been situated anywhere else in the world, apart from at the crossroads of what would become the epicenter of global trade, it likely wouldn't have achieved the remarkable status it enjoys today. Another common pitfall when assuming that other countries can replicate Singapore's success is that people often draw the wrong lessons. Singapore is frequently held up as an example of what can be achieved when taxes and business regulations are kept low. The notion is that companies will establish operations there and, in return, contribute to the economy in various ways. However, the reality is that Singapore does indeed have taxes, and they aren't exceptionally favorable, especially for corporations. A 17% corporate tax rate is on the lower end of the global average, and individuals can find numerous places with zero income taxes. Additionally, Singapore imposes other taxes, including some of the world's highest property taxes and significant costs associated with car registration and ownership. When it comes down to it, the average person and the average company operating in Singapore will likely end up contributing to the government in much the same way as they would in most other advanced economies. They just do it differently. The government's revenue in Singapore represents around 18% of the country's GDP, which is quite similar to the United States. Furthermore, Singapore benefits from its compact size, making infrastructure and service provision more cost-effective and manageable, as they essentially service what amounts to a mid-sized city rather than a vast nation. In reality, the Singaporean government might be collecting a bit more than its fair share. Additionally, it's worth noting that approximately 10% of its workforce commutes from neighboring Malaysia daily, which is another aspect that sets it apart. Moreover, the remarkable closeness of Singapore to its much larger neighbor means that these workers contribute to economic output but aren't included in the country's population count. This creates a peculiar situation where when economists calculate GDP per capita figures, they factor in the output of these workers in the numerator, but don't add them to the denominator, giving this figure an unfair advantage when comparing it to conventional economies that lack this daily cross-border workforce. To clarify, lowering taxes wasn't the secret to Singapore's success. Instead, it was the combination of various factors explored in this video. If a country found itself gaining independence in a region destined to become the global trade hub, empowered a government capable of making near unchallenged decisions that potentially restricted individual freedoms, refrained from abusing that power for self-enrichment, and had no superior alternatives until world-leading industries were established, then, in theory, it could aspire to become the Singapore of its region. However, that's a lot of ifs. Now it's time to add Singapore to the Economics Explained National Leaderboard. We'll start with size. Singapore boasts a GDP of $466 billion, ranking as the 33rd largest economy globally. It outperforms regional counterparts such as Bangladesh, Vietnam, the Philippines, and Malaysia. Singapore earns a solid 8 out of 10 for its impressive GDP. This remarkable GDP is distributed across a population of less than 5.5 million, resulting in a GDP per capita of $73,000. This places Singapore among the most productive countries on the planet, although it lags behind the usual micronation outliers. Still, it receives a commendable 9 out of 10 for its GDP per capita. Next, let's consider stability and confidence. Singapore operates as a multi-party democracy in theory, but has effectively been governed by a single party since gaining independence. This is primarily because the ruling party enjoys widespread popularity and has enabled the country to maintain an impressive level of economic consistency, while mostly sidestepping the challenges that often accompany unchallenged political power. Due to its reputation as a safe haven in the region for trade and business, Singapore scores a strong 9 out of 10 in this category. However, it falls short of a perfect score due to potential complications that could arise from its unique leadership system. Growth in Singapore has been nothing short of remarkable. It had to be to transition from where it was 5 decades ago to its present state. Even in the last 2 decades, the economy has quadrupled in size, with only occasional slowdowns brought about by events like the Asian financial crisis, the global financial crisis, GFC, and COVID, and each time it rebounded quickly. For this extraordinary growth record, Singapore deserves a perfect 10 out of 10. Finally, let's assess its industries. Singapore is home to several highly valuable sectors, functioning as one of the world's largest oil traders despite having limited oil of its own. It possesses a surprisingly robust and technically advanced manufacturing industry, in addition to its role as a global financial center. While it may not lead the world in any of these sectors individually, and hasn't produced domestic companies that compete on a global scale, Singapore still merits an impressive 8 out of 10 for its industry diversity. In total, Singapore achieves an average score of 8.8 out of 10, a remarkable feat that secures its place high up on the leaderboard. Thanks for watching, and take care, mate. Goodbye.